Jennifer, good to see you. Thank you so much for taking the time here with us pre-market. Just take us into your assessment of the additive cost that this tax bill, based on estimates that are floating around, would ultimately mean for the economy and how investors should be thinking through that.
Good morning, and thanks very much for having me on. This is not a shock that we're going to be seeing trillions and trillions of dollars added to the bottom line. And in terms of what it means for the economy, this is, not great news for the economy. I mean, at the same time, everyone's watching ever since, Moody's took away that final AAA rating. There's have been a lot more eyeballs on the U.S. Fiscal deficit side of the page. And foreign investors are looking, and domestic investors as well, seeing how much the U.S. is able to rein in their spending, how much control they have over their spending, and whether or not they are able to do so. And if they can't, obviously we're going to see debt to GDP rising, deficit to GDP, interest payments rising as well. And then, of course, this means ultimately longer term yields on the higher side, and that means higher borrowing costs for consumers in terms of credit cards and mortgages and auto loans and all that sort of stuff. So broadly speaking, not good news for the U.S. economy longer term.
What's that read through, do you think, for the Fed, if that means that the costs for consumers, essentially at the end of the day, for being able to take out or get loans for very high ticket purchases or even high equity purchases, things like homes, especially as the Fed is reading through the affordability crisis for the housing market right now. What is the Fed's assessment here if this is a longer term implication?
Another headache for the Federal Reserve, clearly to think about. But right now they are more focused, I think, on the here and now, what's happening with the economy, what's happening with the labor market. We're going to get a glimpse of that later on this week. And of course, what's happening with the read-through of tariffs on inflation. And it makes their job, Fed Chair Powell's job, much more difficult in terms of how to move going forward. We are, by the way, still looking for a couple of rate cuts this year, starting in September. If I had to lean in a certain direction, if I had to say there was a risk, there may be a risk that they may be waiting a bit longer. Again, waiting to see what the fallout of tariffs will be. So again, also another headache for the Federal Reserve, and especially for Fed Chair Powell.
Jennifer, I wonder how you and your team, as you were mentioning the impact of tariffs and what that could potentially mean for inflation, I wonder how you and your team are running the calculus or any modeling around what the anticipated average tariff rate could be and what it needs to be in order to do what the Trump administration has been saying in terms of the tariffs countering some of the costs of this tax bill.
That is a very difficult one to model. Because we've never been through this sort of situation before. But ultimately, you will have to think that this is going to have some sort of inflationary impact, which is going to slow down consumer spending. We started off the year at 2%, a 2% average effective tariff rate, went as high as 26%, the highest in over a century. And now we're down to about, I think it's like 15, 16% or thereabouts. So we're still roughly 8 times where we were at the start of the year. So that is going to have that sort of inflationary impact. We're still waiting for that to flow through. I've been a little bit stunned, quite frankly, that we haven't seen it come through yet. But I think there are a number of factors at play as to why that is the case. But Fed Chair Powell also sort of gave a little bit of a time frame, I think, last week when he said we have to wait a couple of months to see what the impact of tariffs will be. So I think he said summer, late summer or something like that. So I think September, we're still pretty comfortable with for now.
We know that consumers are at least thinking increasingly about tariffs, as well as that was one of the leading write-in responses with little change since May in the most recent consumer confidence print from the Conference Board. All that considered, consumers are also thinking about job prospects and the employment situation. What is your assessment of where we sit right now and what we could potentially be looking for in this coming monthly jobs data once it gets released later this week?
Okay, so a lot there. So right now for jobs data, we are also looking for a cooling in the job market, about 120-ish thousand jobs for the month of June. Looking for the jobless rate to probably tick a little bit higher to about 4.3%. Again, still very low, broadly speaking, and there's still demand. But, we've been, from the clients that we've been speaking to, everyone's sort of sitting around waiting to see what happens with the tariffs. There's the question, are they even legal? What level are they going to end up at? What percentage is going to be, and what certain sectors is it going to be? Are we going to see like a 10% baseline tariff on everything? we just need to have some certainty. But because we still don't have a lot of certainty just yet, although we are starting to get there, I think consumers are also very cautious about this. As you mentioned, they're concerned about jobs. They're concerned about inflation, although inflation expectations have ticked down. But I just have to say this, that latest report that we saw on Friday for May PCE, obviously the headlines were a bit jarring when we saw the decline, but it was interesting that when you look at the different components of what people were spending on, they weren't pulling back on everything. That would have been more worrying, but they were still spending on discretionary areas like discretionary goods and services, cars, pulling back on dining out, but still, I think that's kind of meaningful that, they're still comfortable enough to keep spending on discretionary areas.
Jennifer, always a great pleasure to get some time with you. Thank you so much.
Thanks.